The real story, the one and almost no one sees, lies in an obscure Depression-era relic called the gold certificate account. Created in 1934, it forces America's gold to be valued at just $42 an ounce, a fraction of today's market price. Hidden in that accounting quirk is a reservoir of untapped wealth. The U.S. claims to hold 261.5 million ounces of gold. On paper, that stash is worth just $11 billion. At today's price of over $3,300, it's worth nearly $900 billion, almost 3% of U.S. GDP. So what happens if Washington decides to reprice gold and credit the difference to the Fed? Suddenly, the Fed's balance sheet fattens. Treasury's account fills with cash, which will be spent quickly, and the government sidesteps another debt-ceiling circus. For now, anyway. And suddenly, the Fed just took control of the United States' entire gold stash. Now, I know what you're thinking, but the Federal Reserve already owns those claims. And you'd be right. But here's the punchline. The Fed only owns claims locked at $42.22 an ounce. Because the Fed can't own the gold directly, the United States could theoretically pay those claims back in cash. In other words, the United States could buy back nearly $900 billion of gold for just $11 billion, leaving the Fed with no claims against the gold. But of course, the Fed won't let that happen. Nor would revaluing make any sense for the United States without an ability to monetize that gold. So, after the United States buys back the gold for $11 billion, it then immediately sells it back to the Fed at the market price of $900 billion. The United States gets $900 billion worth of Fed dollars without borrowing, interest rates, or printing any new money. The Fed gets $900 billion worth of gold for, well, nothing. That's what revaluation means in a nutshell.